Hello everyone, and nice to see you. We've got a great panel today. We're talking about climate adaptation, and climate adaptation, of course, is how we prepare for a world of rising temperatures and both the physical and the social ramifications from that. And of course, we could talk about that from a policy perspective, we could talk about that from a science perspective, but we're at the Sustainable Business Summit and you're in Bloomberg's headquarters, so we're going to talk about it through an investing perspective and a markets perspective. And that's great because we have two investment people here on our panel, Liz and Mark. So I want to talk to you both to start off the conversation. In theory, on Wall Street, anything can be made into an investable theme, but is climate adaptation really something that investors can grapple with in a portfolio, kind of have positions around? How can they do that? How do you do that? If possible, there are some examples you can share, and perhaps you could talk more generally about this theme. So how does it become an investable idea? Mark, perhaps to start with you.
Yeah, that's an interesting question. Actually, I have the benefit to be in private equities. So we invest in companies that innovate, that develop new solutions. And clearly, climate adaptation is a key thematics. We observe over the last decade a flourish of innovation of people that try to find solutions. Because actually at Mirova, our conviction is to solve the challenge we all have. Innovation is a core part of the solution. And so selecting companies that innovate and bring solutions is an investment theme by itself.
What would be an example of that?
An example, for example, I was this morning with one of our companies named Ombrea. Ombrea, they are agronomists. They have developed a system to adapt the culture against the climate change and the hazard coming with it. So already in Europe, a lot of culture like vineyard are no more adapted to the climate as it is. And so you have to somehow to control the climate. And what they do shadow system to protect the microclimate below the system to avoid too much heat or too much sun and so on. And this company is growing extremely fast. So it's by itself an investment thesis.
And how about you, Liz, more on the public side, perhaps in the private?
Yeah, so we also have renewables in our portfolio. So we invest in solar farms, which obviously help with the green transition. But on the public equity side, we have a climate tilt on our index tracking fund. And so we are trying to tilt towards companies who we think are well positioned for the transition, and we try and tilt away from companies who we think will have stranded assets, or we don't think their management are taking the challenges that we all face sufficiently seriously. So we try and do it both ways. We also extend that to emerging markets and to our investment grade credit portfolio, because it's very easy for people to say that you deal with it in equities, either public or private. But actually, this is something that matters across your whole portfolio. And restricting access to financing for public companies via the credit markets is probably the most effective way to get change. So we think it's important you apply your standards consistently across portfolios.
So that would be different to we talk a lot about, on our team here at Bloomberg, we talk a lot about the sort of debate of engagement versus divestment. How does that feature here then? So on the credit side, that's not quite divestment, what you're saying, but it is using the levers of the debt market to press companies to do more. That's kind of more ramped up engagement, perhaps.
Absolutely, and I think it's really important as investors we decide, are we trying to target a number in our portfolios? Are we trying to get our carbon footprint down? And that's the end objective, or actually are we trying to drive change? And it's no good to me if I just pass my I sell a company and Mark buys it. I'm sure Mark's firm wouldn't buy it. But nothing has changed if that's what happens. So we think we need to try and drive change in the economy, just not just focus on numbers in a portfolio.
Very good, okay. Well, one thing I'm keen to talk to you about, so climate adaptation, we can't really have this conversation without talking about physical risk. It's in the risk of physical manifestations of climate change, whether that be wildfires or flooding and so on. And it seems to me as if the investment community, this is a broad and general comment, has focused much more on transition risk. If we look at GFANZ, for example, a couple of strands of their work is focused on transition plans for corporates and transition plans for financial institutions. As part of the kind of Climate Action 100, 100 plus, their piece of work is also focused on transition planning. The Transition Pathway Initiative is part of what they do. And it seems like there's been a big emphasis on transition risk because that's sort of the thing that's happening right now. And all the net zero commitments are in some way contingent on getting companies to kind of rewire and to change the way they operate. So there's transition risk associated with that. And the assumption has been that physical risk is sort of it's coming, but it's in the background. Do you think sort of recent events, if we're looking at flooding in Australia and wildfire in Australia and California and things that we've seen in Germany, perhaps closer to home, suggest that physical risk is no longer sort of a distant threat, but more of a kind of present reality? I think Sadiq Khan just said something around like it's a now. He was talking about flooding in London as a now problem. Do you kind of think of it in that way, that physical risk has somehow risen up the agenda and requires a greater attention from investors?
Yeah, I think we are in the change. It's not something in the future. So yes, I think with the climate change, you have some new risk. And as an investor, you have to question the company you invest in to check if they have taken into account this new risk. And yes, physical risk is here, and you have to factor in your analysis this risk. I think it's something you have to do.
And is it potentially more destructive to a portfolio than transition risk?
Frankly, it's the same. It's the same. It's just another way to look at the issue. I think maybe when you say transition risk is the ability of your company to adapt and to change its practice, and physical risk is what are the immediate consequences on its operation coming from climate hazard. But at the end of the day, they have to adapt. If you operate an aquaculture farm in a place that will be flooded very often due to the climate change, you have to move it. I think you have to adapt. So it's the same risk at the end of the day.
We're certainly seeing in insurance markets that whether there is actually more physical risk or whether it's more immediate because it's closer to home and therefore we pay more attention to it, I think there's an open question there. Right. And certainly a lot of the places that have been suffering within Europe or within America, they're insured losses rather than being in remote places which tend to be uninsured losses. So you are seeing already the impact on portfolios of those losses coming through. But also you start appreciating the disruption to supply chains. I mean, we've all experienced the COVID disruptions, but there was flooding in Thailand which knocked out semiconductor plants. That caused disruption even pre-COVID. So it's understanding those supply chain challenges for your businesses, I think, is increasingly important.
So, I mean, ESG, which is sort of the thing I'm writing about all day, is in theory I don't know if new is the right word, it's a different way of looking at a company. You're not just looking at the financial metrics, the cash flow and EBITDA, but you're also looking at, what's their transition plan, for example, or how are they treating their employees and how good is their governance. But then with the physical risk, it seems like there might be another important element here, and that is where are their operations? And back to the supply chain point, where are the operations of their suppliers? Do you think that sort of physical climate risk creates a new or necessitates a new way of looking at companies?
I think it increases the importance of, and particularly if you're running concentrated portfolios, it increases the importance of understanding where your firm's operations are, right, so that you know when to react and perhaps when you don't need to react so much.
But this risk has always existed. Just the magnitude and the frequencies that have changed, that force you to take it into account more. But I think normally when you, as private investors, we have more granularity and knowledge on the company we invest in, but you have to, since ever, to consider what are the risks of the company you're investing. The difference now is that you have new events that may hit you and that you have to factor in your analysis. So I'm not sure it's totally new. It's just the magnitude has changed.
Okay. And within the concentrated portfolio example that we're talking about, have there been examples where you've had to say to portfolio companies or prospective portfolio companies, guys, you might want to move your operations from this floodplain prone area, this somewhere else?
For us, not yet, but we were close to that. Yes.
Okay.
But usually, if we also like to invest in companies that are well managed with good manager. And frankly, if it's us as an investor that have to open the eye of the management, maybe you have to question the quality of the management to start with. So to be honest and modest, I think in most of the cases they are fully aware. And we are here to help them. But I think we are not really the eye opener. Otherwise, maybe you shall not invest because the management is not good enough.
Okay.
Real estate portfolios are the other place this comes home to roost. So choosing where you put your shopping centre, choosing where you put your office building, and thinking forward to whether those areas are at risk of flooding, which would obviously make them rather less valuable if you can't access them for long periods of time. So I think for real estate portfolios, it's important to be planning ahead. The other example, and I don't have any experience of investing in municipal bonds, but I was shown some really interesting analysis that compared the bonds from two different counties, and the headline pricing was the same, but if you looked at the flood risk between the two areas, they were wholly different. And you might argue that one of those bonds was actually more valuable than the other one. And I think that's a really good example of how this seemingly very intractable problem, you don't know where the flood is going to happen, but if you can see that one county is more at risk of flooding than another one, perhaps you should systematically be valuing those bonds differently to reflect that risk.
Yeah, it was in the US?
It was the US, yeah.
Okay, interesting. Let's talk a little bit about emerging economies, because that seems to be where the climate adaptation and the physical risk is most relevant. It's emerging economies perhaps that will bear the brunt, in theory bear the brunt of rising temperatures perhaps more than others. And of course, as we talk about emerging economies, there's the whole just transition concerns too. And I wonder, as investors, how do you kind of marry those two things, or how do you walk that line of sort of thinking about investing in emerging economies, the impending climate risk and adaptation coming there, but also the just transition, and how you marry those things? I mean, perhaps I could start with you there.
Yeah, I think for us, we think very hard about which economies are most at risk, the strength of the financial institutions, the governance structures in those economies. So who is likely to be able to adapt to climate change and mitigate climate change? I think as a developed economy, we have a huge interest in trying to help emerging markets make this journey, because the mass migration that we would see, because those areas are going to become uninhabitable if the worst scenarios play out. And it will be a mass migration of the size we have not seen before. And typically that's not something that goes down very well in developed markets. We tend to close our borders and close ranks at that point. So I think we have a real interest in trying to help countries mitigate climate risk and adapt to it. But we're very keen to only give our money to places where we think it will be spent wisely. We aren't in the business of giving our members money away to places who are going to squander it. So trying to assess who will do well with that money and who will waste it, and direct accordingly, I think is important.
And how do you judge that? That's just regular governance metrics, or?
Yeah, so I mean, there are various people who score strength of institutions and political risks in countries. You can look at where the financing comes from. So our budget deficits, are they going to be able to raise taxes to repay the debt that you're giving them? So you can look at both sides of the equation.
Okay. Mark, did you want to wait?
Well, I think we are less exposed. I think if we were to invest in an emerging country, we look at the quality and of the infrastructure of the country to be able to assess also if the company we will invest in are able to operate properly and how they can be impacted by a climate event and change. And also what is very important when you invest is our ability to exit. So yes, having a view looking forward on the ability of the country to adapt is important because we invest for long term. So investing is easy. Exiting is sometimes more challenging. So it's important to consider this part of the risk when you invest in an emerging country.
Yeah. Okay. And Mark, if I stay with you for a moment, I know that we had this discussion before, that a lot of climate conversations can end up being rather doom and gloom. But you have some thoughts on how one can be opportunistic or not opportunistic, how one can be optimistic, I mean. Possibly also opportunistic as an investor when looking at climate adaptation.
Yeah, I think nobody wants to take advantage of the situation, but I think we can be optimistic because, as I've said, we have a strong conviction that one of the big characteristics of human being is its ability to innovate and to adapt. So we believe that as investors, we shall support initiatives that innovate to develop solutions. And by doing so, we may actually also have a proper financial return. And also, I think by taking into consideration this non-financial matter, I think we have a better analysis about the quality of the investment. The image I like to use is if we were in this room in the 50s, we will only speak about financial return. The only consideration was the level of return. Then at the end of the 60s, people discover the risk. The famous Sharpe ratio was invented in 67, so 55 years ago. And since then, we have all been educated to move in a plan where we look at risk and return, and we look at the efficient frontier of our portfolio. In all the MBA, we learn about how to optimize risk and return. We just discovered that we are not in a plan, but in a cube with a third dimension, which is a non-financial risk. Could it be the environmental, social, physical risk? And so instead of having an optimal frontier on a plan, it's in a cube. So by just taking into account this dimension in your investment decision, you have a better portfolio because you have a more elaborate view on your risk.
Liz, do you have a view on 3D thinking on portfolio construction?
Yeah, I mean, I completely agree with Mark. I think, and sometimes people say, oh, it's too hard, and I don't know when it's going to happen, and I can't be precise enough. And somebody wiser than me said, if you can see a wave coming, just stand in front of it. And you don't have to be precisely right. You just need to position yourself to take advantage or to benefit from that change coming. So I think getting overly fixated on, is it going to be this year or next year, and is the carbon price going to be 80 or 90 or 120? It doesn't actually really matter. You just need to position yourself so that you're on the right side of that big wave when it happens. I mean, we outsource our investment management to asset managers. But we're very much keen on people looking at ways of doing things differently and not keeping that closed mindset of, well, it's always been this way, so it should carry on being this way. The world changes and we need to change with it.
But is the optimistic view then only sort of predicated on developments in technology and innovation?
No, in the ability to adapt. It's not only new technology, it's also to change the way you do things, maybe to have a better view at your supply chain, to be less energy, to use less energy in your supply chain because you look at it differently. So it's not only innovation. Just innovation is part of the solution, but it's really the ability to adapt.
And within the UK, we look after the pensions we're a workplace pension. We look after a lot of low-paid people. The just transition within the UK is important, and that will throw up opportunities as well, because people like the idea of adapting to climate change and they agree with transition plans, but when they see it might cost them money, they tend to be less thrilled about it. But I think it's up to governments to try and show what's in it for other people and to support that transition so that it genuinely can happen. And there will be great opportunities for investors to support that and make sure everyone goes on that journey.
Very good. Well, I myself have possibly several more questions, but let's open not open the floor, but as Meg, we have some audience questions.
Yes, starting with pension assets represent a very significant portion of assets that are managed globally. How can pension beneficiaries get more involved in the debate on how their savings are being invested?
And that's for you, Liz.
So at Nest, we have just launched a platform called Tomelo, which allows our members to see where their money is being invested in the public markets. And that, I think, is a great way of them seeing how we're putting their money to use. Nest has the benefit of only being set up about 11 years ago, and so we're built entirely on technology, new technology. We don't have any legacy systems. And so our communications team and our member engagement is actually, I think, quite easy for people to interact with, and we're quite open about where we are investing their money.
Great. And you kind of answered this, but just to maybe clarify a little bit more, are you investing for profit or social impact at Nest? And if profit, how much does the social impact measures impact your decisions that you're making?
So we absolutely have a fiduciary duty to look after members' financial interests. And so we will always make sure that we are earning a good return on members' money. We think that that's our obligation to do that. But equally, we try and avoid giving money to things which will have negative impact. So one of the phrases that gets used is a bigger pension in a better world. Our members will retire. We are a universal investor. We invest all around the globe in all sorts of different asset classes. And we think we shouldn't leave more damage behind than is necessary.
Yeah, and I think just for Mirova, I think I can say it's the same. We truly believe, as I've said, that you cannot oppose having a positive impact and having a financial return. I think the two have to come together. So it's not a trade-off you do between the two. It's really just in your investment decision to combine the two dimensions together and to have a better return because you have a better impact.
And it plays to sustainability of returns as well. If you are a business which is damaging or abusing your workforce or taking advantage of the environment, generally that comes back to bite you. Our members, if they join us at 25, they might retire at 67. We hope that they will have long, extended retirements, but we need sustainable returns from sustainable businesses. That's the best way of serving them, rather than companies who try and make a quick buck, but then they either get forced, they lose their license to operate, or they lose public trust. That's a very bad way of doing business.
Is there a final question, or can I ask?
You go, yeah.
Okay, thank you. Well, my last question is just to ask you to elaborate a little bit more. I'm very interested in this idea of there being a trade-off or no trade-off between a better world and financial returns. I'm not sure I'm entirely convinced that you can have both at the same time. Convince me if you could in,
I think
in the
it's
few
simply,
seconds we have remaining.
No, it's simply the question of what is the duration you factor in your analysis. Okay, as soon as you have a medium to a long-term view, you have to factor in your sustainable dimension in your investment decision because, as Liz was saying, otherwise you will not have a sustainable investment. And I think that's the way to reconcile the two, is by adding the time dimension.
Right. Okay.
It's the time that makes the difference. And as soon as you are not short-term traders that want to make money for tomorrow night, but you say, okay, no, I'm here to contribute to the economy with a medium-term view, then you align the financial return and the sustainable impact.
Would you like 10 seconds, the final word?
I never resist the final word.
Very good.
So I think it may not be a better return, but if I can get the same return with less impact, I think that's a result.
That's a win.
Yeah.
Fantastic. Well, on that note, thank you, Liz, Marc, very much, and thank you all for listening.